No one can predict the future, including the Federal Reserve, that has repeatedly failed in that task in the past. As I've discussed in my blog and in several videos here, I do not view it as more probable than not that the Fed will cut the federal funds rate by 75 basis points by year end, unless inflation resumes its downward trend, which is certainly a possibility, or the economy starts to tank, which I do not view as likely this year. It is probable that there will be at least one 25 basis point cut on or before the September meeting, probably at the July meeting, and at least one more before year end or in the 2025 first quarter. In other words, I remain skeptical about the dot plot forecast that was released today and the projection materials that still had a majority of Fed members calling or projecting a 75 basis point cut in the federal funds rate from its current range of 5.25 to 5.5% by year end. The most that can be done now is to assign probabilities to future scenarios based on what is known now and to fashion alternative investment strategies based on currently projected probabilities that are subject to change based on subsequent events. Since I now believe that the Fed will cut rates, though the timing and number remain uncertain, that will cause me to move more interest income into 2025, since I anticipate that my short-term treasury bill investments will start to trend down in yield as the year progresses, leading to lower interest income in 2025 compared to 2024, assuming I do not soon address the issue. I discussed this matter in a previous videos, which I will link in the more section below. As I stated in earlier videos, I can shift some income now, interest income, into 2025 by increasing my purchases of 6-month treasury bills starting in July and by buying more 1-year treasury bills at the monthly auctions. But that does not solve the reinvestment problem, which I have stated is my most serious problem that I have, that originates from a steady decline in short-term interest rates well into 2025, given my extremely high weighting in short-term maturities. The fashioning of an investment strategy using the more probable than not scenarios also involves identifying stocks that pay good dividend that become more attractive with interest rates falling, particularly in light of lower returns from the credit risk-free treasury bills. Sectors that may benefit include real estate investment trusts, pipelines, and utility stocks. Buying stocks in those sectors is a way to play lower interest rates longer term than I can do with treasury bill purchases or even short-term corporate bond purchases. The current dividend yields for many stocks in those sectors have become more attractive as the fixed income alternatives become less so. For equity REITs, which means those that own real estate rather than paper assets, cash flow will improve with lower interest rates, since many have significant variable rate debt that has been eating into funds available for distribution at the current short-term interest rates. I will discuss small adds to 2 equity REITs that I own in my next post. Another option is to consider a balanced closed-end investment company that borrows money at short-term rates and buys bonds, convertible preferred stocks, and bond-like stocks like a real estate investment trust, utilities, pipelines, and telecommunication companies. If you are unfamiliar with the closed-end investment structure, you can learn more about them at CEF Connect, all runs together. Those funds have seen their borrowing cost rise so much that it exceeded, in some cases at least, the yields of investments bought with the borrowed money, which has led to some dividend cuts. And the investment in bonds and bond-like stock sectors responded negatively to the rise in interest rates that started in 2022 springtime and continued well into 2023. I will be discussing in my next post adding to an existing CEF position and a leveraged, balanced one that invests in those kinds of sectors, including bonds, convertible preferred, utility, telecommunications, and REITs. A sector that will experience lower net investment income when there's a downtrend in short-term interest rates are business development corporations, companies, BDC for short, who have a preponderance of loans at spreads to short-term interest rates, while much of their debt is at fixed coupon rates. As interest rates fall, and I'm talking about short-term interest rates falling as a result of Fed cuts in the federal funds rate, the net investment income total will decline for those BDCs as loan coupons reset at lower rates. If you look at a BDC annual report or the last quarterly report, the 10Q, at the SEC website, go to near the end and there will be a section that shows the net investment income impact resulting from increases or decreases in interest rates, and you'll see what I mean here. I decided to pick on Prospect Capital, symbols PSEC, to highlight the impact, and I'm referring to page 144 of the last filed 10Q. A 300 basis point decline in interest rate would reduce net investment income by an estimated $77.146 million and down $41.204 million for a 200 basis point decrease. Interest costs by PSC go down, but interest income from these floating rate loans priced at spreads to short-term rates goes down a lot more. Conversely, the floating rate loans made by this BDC produce more interest income as rates rise. So they have benefited by what has happened at the Fed starting in March 22 when the Fed abandoned ZIRP and started to raise the federal funds rate until it hit the 5.25% to 5.5% level that it is at now.